Hello and welcome to this week's Market Mondays webinar. My name is Kyle Rodder, Senior Market Analyst at Capital.com. And of course, it's wonderful to have your company once again this week. We'll dive right in because, of course, there's a little bit going on, certainly not as busy on the markets or on the calendar as what we've seen in previous weeks, or at least a couple of weeks ago when we had that extraordinarily busy week. But before we dive into the substance of things, we just have to include, of course, the risk warning. That's to say that, first of all, everything that you hear here is of a general nature only and only takes into consideration, or doesn't, I should say, can take into consideration anybody's personal circumstances. It's only general advice. Please consider your risk appetite and risk profile before trading CFDs. In addition, for those who are in the UK, the warning also covers spread bets, and it's to say that, of course, these products and CFDs are risky and you should consider your risk profile before trading them. To take a look at what we'll be discussing at a high level this week, Wall Street obviously close to record highs, worth breaking down sort of the trade setups there or technical setups there, especially given the fundamental backdrop, driving the bounce that we saw last week and potentially driving the trend higher in the week ahead. The big event as far as calendar or event risk goes might be considered to be US inflation data. We'll get that in a couple of days' time. It should also be interesting considering the PCE figures that we got a week ago or 2 weeks ago. There's a bit of geopolitical risk on the calendar as well. We've got the trade talks between the US and China, or really the trade deadline, I should say, on August 12th expiring. So we're waiting to see if there is an actual extension provided there. There's some US-Russia talks as well, putting on the table a possible truce with in the war between Russia and Ukraine. And of course, to appeal to the parochial Australian in me, the RBA is the big central bank decision for the week. It's tipped to cut interest rates by 25 basis points, possibly more. We'll have a discussion about that as we push on. But let's go straight to the markets and discuss really what's been driving this move to, back to record highs for the likes of the S&P 500. And we saw last week that despite that sort of sell-off that we experienced on Friday a couple of weeks ago, thereabouts, off the back of the August 1 trade deadline and the downside surprise in US jobs data, that Wall Street has managed to recover a lot of those losses and come very close to record highs. And in fact, before we talk about the technicals on the chart there, I did want to just point out some of the key factors and illustrate a little bit off this page exactly what is supporting the market at the moment. And essentially, it's two things. It's company earnings and interest rate expectations. That is, of course, given the data that we've received recently, ISM data last week, for example, the prospects of a rate cut from the Fed over the next meeting, possibly or two. First and foremost, though, I just want to discuss how good US earnings have been for this period. Just starting with the overall look at what has been seen from US companies for the second quarter. S&P 500 earnings growth has been around 12%. This is the blended earnings estimate. We've got about 90% of companies already having reported. The big one that hasn't reported yet, of course, is Nvidia, which isn't for another 2 or 3 weeks. But we've got the S&P 500 delivering almost 12% earnings growth for the quarter, which is in line with pretty much what we've seen in previous quarters as well. Much better than the nearly 5% expected earnings growth that analysts had coming into this earnings period. You can see that down here for the 30th of June. The S&P 500 was estimated to deliver 4.9% EPS growth for the quarter. Absolutely shot the lights out on that expectation. Of course, the bar was set pretty low because of some of the downside risks to earnings that analysts expected because of trade uncertainty and US tariffs. Nevertheless, they didn't materialize. But the big driver, as we are so used to from Wall Street companies or for Wall Street, some of those big tech names. And, obviously you can see the IT sector here. The IT sector doesn't actually capture all of the Magnificent Seven stocks. They're split across communication services, obviously information technology, but also consumer discretionary companies as well, which have certainly beaten expectations, albeit, the likes of Amazon are included in the consumer discretionary sector. The earnings growth hasn't been that robust, around about 5%, but certainly better than the contraction expected. But, those really big tech names, we're talking about Meta, we're talking about Microsoft, we're talking about Apple, contained in communication services and information technology predominantly. and shot the lights out. Communication services obviously delivering 45% earnings growth year over year since last quarter. IT stocks around 21%. And just to give a little bit of a high level overview as well of just some of the key figures out of this reporting period. And of course, I have to reference here that this is FactSet, a really great data provider that provides this earnings insight update every week on a Friday. So if you're really concerned with market fundamentals, this might be a resource for you. But 90% of companies have already reported, 81% have beaten expectations, which is at around about a 3 to 4 year high as far as beats go. So really, really solid across the board. There are some knocks on the market in terms of valuations where we are seeing forward price to earnings multiples still at levels that we saw at the start of the year when everyone was sort of crying that stocks were a little bit too rich. But nevertheless, you see earnings beats, investors buy into that news, and that's one reason probably why we've had the major US indices bounce back from those post-jobs data, August 1st trade deadline lows. The other element, of course, is what's going on in interest rate markets. And that directly relates to what we got from the jobs data on Friday a couple of weeks ago. And then, of course, to an extent, the ISM services PMI, ISM services PMI data last week, which was lower than expected, showed a big drop, a 5 year low in the employment subindex. There was, of course, a bit of a jump in the prices paid component. That's a tariff story. But still, the markets are pricing in that more than likely the Fed will be cutting interest rates when it meets in September. That's also been added to by the fact that we had the Trump administration elect Stephen Miron, also of the Council of Economic Advisors to the President, as a temporary board selection to the US Federal Reserve, creating a little bit of a dovish tilt there. There's also speculation that maybe someone like Christopher Waller will be the next Fed head. He's been a dove for quite some time, perhaps even a little bit prescient because he was one of the dissenters at the recent Fed decision calling for an interest rate cut because of a perceived deterioration in the labor market, which again, he called a little bit before we got that official jobs data on Friday a couple of weeks ago. But we've got effectively valuations being supported now by the impact of expectations around a Fed cut in September, and then also potentially a federal funds rate that could end the year 75 basis points thereabouts lower than where we currently sit, which would effectively say that there is a cut to occur at every meeting before the end of the year. So that's what's supporting Wall Street and stocks from a technical basis. I should say a fundamental basis. We look at the technical basis now, and things get a little bit interesting because effectively we saw that bounce off support at around 6,200 for the S&P 500, and now we approach again the resistance level at what was previous higher highs, which will more or less tell us if it breaks, this is an uptrend that is still in place and that the bulls are still in control of this market. If it breaks down and then we see a retest of that 6,200, maybe a break, we have a structural uptrend at the moment, clearly higher highs and higher lows. But if we don't see if we see that previous low broken, that starts to bring into question whether there's a deeper drawdown. I have a bias at the moment that maybe we will see a deeper drawdown here, really on the basis of valuations being a little bit rich, seasonality being a factor because normally things get a little bit thinner over the summer holidays in the United States, and then also on top of that too that we've got positioning quite stretched as well. A lot of people in this trade, long US stocks. Of course, we want to follow the price action, and the confirmation will come of some kind of a pullback if we do see 6,200 broken. That sort of says again that the uptrend is structurally weak and maybe breaking down. That gets negated if we break through 6,400, we'll call it thereabouts or 6,440 perhaps at the previous higher high. That story holds true as well if you look at the NASDAQ, which is also finding a little bit of resistance there at that previous record high at 23,700, perhaps 23,700 and change. And you look at that previous low there for the market, similar to the S&P 500, where we saw a bit of consolidation in the past, maybe some oscillation around that sort of 22,700 level. Again, those sort of lines in the sand to sort of delineate perhaps whether this uptrend continues or if it starts to break down and we get that bigger drawdown as maybe markets flush out a little bit of froth. In terms of the big events this week that could drive that, well, the largest of them all will be US CPI data. And it's expected, we'll go to the calendar now just via Forex Factory, which we'll be able to look at just what markets are expecting coming up from that inflation data. And you can kind of see there that headline CPI is expected to pick up to 2.8%. But we're also expecting perhaps core CPI on a month-on-month basis to lift to around 0.3% and another pickup in core CPI as well into the high twos. There's two ways to slice this. One, a pickup is expected. It's already in the market. So if we get an expectations figure, even if it does show a rise in inflation, especially on a core basis, that would be more or less in the price. But the other element that is suggesting that maybe the markets have a little bit of wriggle room is that the Fed is anticipating a pickup in inflation, of course, on its PCE metric rather than the CPI metric. With a core PCE figure forecast before the end of the year in the latest summary of economic projections to around 3.1% from memory, certainly has a 3 in front of it. So that suggests that the Fed is still willing to cut interest rates through a potential rise in inflation if it happens to occur. So we'll have to see a fairly meaty upside surprise in this data to perhaps see those interest rate cut expectations pulled out, and maybe the markets respond, with a bit of a sell-off in equities. The US dollar you would imagine, push higher as yields climb there as well. It really does depend on the dynamic there. You obviously wouldn't want to preempt that news, but that inflation data is, really key to driving those expectations around monetary policy. And then again, given the fact that monetary policy expectations have driven this bounce in US stocks, very crucial to see if we get perhaps that break to a new high, or maybe a retest of that previous level of support. Another point to make in the long term is there's this lingering question about to what extent is US inflation re-anchored at a higher level. And I think there's a very strong argument to suggest that maybe even the Fed is aware of this, and is very, very much furtive about the subject, reticent, I should say, to sort of discuss the fact that prices may have, or inflation may have re-anchored at higher levels. But if you look at the data over the last 12 months or so, maybe even more at this point in time, inflation hasn't gone below 2.5% really on the PCE gauge. It's just in the high twos, flirting every so often with the low threes on the official CPI number. That number isn't, inflation isn't progressing to that 2% goal for the Fed. Clearly, the Fed doesn't want to risk the labor market just to get inflation back to 2%, especially because a 2.6, 2.7, 2.8% core inflation rate on the PCE, while clearly not the Fed's mandate and clearly problematic for some in the economy, isn't the kind of 6, 7, 8% that we saw after the pandemic. So they seem to be sort of quietly ignoring that and just keeping an eye on the labor market, keeping rates steady, which again the Fed suggests that policy is still at relatively restrictive levels, hoping that just over time they can take some steam out of prices and get it back to 2%. The big question is obviously to what extent that the tariffs lead to a sort of a one-off bump in inflation, and they're very cognizant of potentially seeing a situation where that bump leads into higher inflation expectations and a further re-anchoring of inflation pressures higher. That's the $64 trillion question, billion perhaps, for the Fed at the moment. So that's one of the key risks to look out for. It'll also be a bit of an influential one on gold as well, which I'll have a bit of a look at very, very quickly here, because it's fairly relevant as we see gold sell off once again after some confusion last week about what tariffs are going to be applied on gold. There's been a little bit of a clearing up of that now, and so there's less fears about potentially the same dynamic that we saw in copper prices, where there was a big run up in some futures exchanges on more or less this kind of arbitrage dynamic. Gold's pulling back a little bit, hasn't managed to break through 3,400 on a sustained basis. A lower than expected inflation print might be a driver to push gold higher. Something a little bit stickier might see gold pull back again. Interesting setup, because again we've got this clear level of resistance up here at 3450, maybe a little bit below that, which you'd really want to see a break above and a consolidation through before you can sort of suggest that this sort of structural uptrend for gold is actually still intact, and the bulls are back in control. But we very interestingly have this kind of series of lower highs creating this kind of slight wedge pattern, or triangle pattern, you could argue, that is kind of suggesting that things are coiled up, and that the risk is still skewed to the upside. But you would want to look for that kind of breakdown in that kind of move. Certainly we saw this kind of support again around 3,200 before this latest bounce, a breakthrough there before kind of suggesting that again maybe gold, like stocks, could be ready for a little bit of a pullback after such a hot run for most of the year. That takes us to some of the geopolitical risks this week. Obviously, there is the trade deadline between the US and China that's set to elapse on August 12th. There is a confidence that that will be extended, maybe that the charco trade will be, in full swing once again, especially as these negotiations between the US and China play out. There seems to be a real reluctance from the Trump administration to really go too hard on the Chinese, albeit, there is still a tariff rate touted of about 30% on Chinese imports into the United States, which would be still a significant number, but certainly lower than the level threatened during the post-Liberation Day period, and even at certain stages coming towards the last trade deadline extension, which could have seen, obviously, a tariff rate in the triple figures, certainly possibly higher than that. An interesting point to say is that the Chinese have a lot of leverage in these discussions, and we've seen that just because of the way that they've threatened to disrupt rare earth supply into the United States, which is obviously key to the US tech industry and its dominance from an economic and strategic perspective. The Chinese have been very cunning in using that kind of leverage point to make sure that the US clearly goes pretty hard in terms of their trade rhetoric, but not so hard that it sort of results in effectively that trade embargo that would have occurred had we seen the kind of triple digit tariff rate applied on China that was threatened right after Liberation Day. So that could be a factor if we do see that the trade deadline elapses without any kind of extension. That would certainly lead to a bit of a risk-off move. Maybe gold will recover in that sort of on that sort of basis. Maybe the US dollar would also appreciate there too, because the dollar seems to have once again regained this kind of risk-off appeal here and there now that positioning's cleared out. But one to pay attention to. The other one is talks between the US and Russia in Alaska. Ostensibly going to discuss a truce between the two countries. Of course, to what extent any kind of truce is going to be effective without the Ukrainians with a seat at the table is a very, very open question, one that sort of goes, beyond my scope as a market analyst. Obviously, I'm not a geopolitical strategist or something of like was, something of that nature. But nevertheless, if we do see some kind of, positive breakthrough that kind of leads to a de-escalation there, as unlikely as it would happen to be, you must, of course, keep an eye on things like natural gas prices and crude as well, which seems to be pricing in, not only just a weaker demand backdrop because of these tariffs that are being applied across the globe, but also that, combined with OPEC opening or letting the taps loose to some extent, there is hope that maybe supply will sort of normalize a little bit given or not even normalize, but supply will increase and this imbalance between supply and demand will increase if, the Russians and the US are able to kind of somehow nut out a deal. Again, a bit more of a tail risk there, given the fact that the Ukrainians have expressed reluctance about giving up substantial territory, but still one to keep an eye out for in the week ahead. Talking about central banks now, before we go to the RBA, also very relevant to note what we saw last week from the Bank of England for those who follow the Bank of England, or at least markets from the in the UK, is that we saw a very interesting dynamic of a vote split of 333 on the Monetary Policy Committee last week. A few voters opting or preferring a 50 basis point cut, a few suggesting a 25 basis point cut, another handful suggesting that a hold would have been appropriate. Really shows at the moment just the very difficult set of economic circumstances that the UK confronts, and arguably the limitations on monetary policy as the economy remains in a relatively high inflation environment, 3+%, but also with sluggish growth and a labor market that isn't really adding jobs meaningfully, the unemployment rate kind of, ticking higher progressively as well. You could argue that's, some kind of stagflationary environment. Maybe that would still be too strong a term to use for it. But nevertheless, these are structural factors in play for the UK economy. Having just come from there recently, you can certainly feel that, the standard of living there is slipping. There's a lot of pessimism about the economic outlook. Obviously, fiscal conditions are a very contentious point as the government tries to put public finances in a more sustainable basis that simultaneously ensures that demand remains well supported, that the welfare state remains well supported, but at the same time that the money is flowing to areas of the economy that is going to drive productive ends and therefore stronger growth and lifting living standards in the long term. the fact that we saw that kind of vote split, that uncertainty across the board, and then eventually a 25 basis point cut rather than a 50 basis point cut, kind of gave the pound a little bit of a lift last week. And you can arguably see that we made a very clean retest and bounce off about 130, 140, 130, 130 thereabouts at this low here before springboarding back and arguably breaking that sort of very modest downward sloping trend line, which could herald a little bit more of a run higher here. Obviously, it's going to depend greatly on what happens with the US dollar because that's been far more influential. But if we do see a bit of weakness through the US dollar, maybe a lower than expected CPI print, there seems to be the impetus for the pound to move higher. The next level to watch is around 135.70, as I would argue, just because that's the lower high that we saw here after obviously that kind of high points, that high water mark at around 138 a few months ago when we saw the US dollar, clearly hitting the lows of the year. That helps us move on to the RBA now, and that's where we'll wrap things up. As arguably the biggest event for the week as far as volatility risk in an individual market, just on the basis that it's a live meeting, market participants are even betting that there's a possibility of a 50 basis point cut. Certainly, if a 25 basis point cut is fully priced in, and the reason why that is the case is that we had inflation data in Australia a few weeks ago, showed that the TRIM's mean, which is like the core inflation figure, the official inflation figure, was about 2.7%, which was in line with where the RBA in its most recent statement on monetary policy had forecasted to be. Technically, it forecasted it at 2.6%. That was the May summary statement of monetary policy. But the February statement of monetary policy was at 2.7%. It still had forecast interest rate cuts for the year on that basis. And not only that now, we also have had data suggesting that the labour market is softening considerably and that the RBA has the ability now to focus on its employment mandate rather than its price stability mandate, now that it has got that official CPI figure to suggest that things are kind of moving in the direction expected. And it should also be said, the CPI indicator that the RBA releases monthly and is only a partial representation of the full inflation basket is suggesting trim mean inflation somewhere down in the low 2%, maybe headline inflation pushing even below that, which says that, basically demand in the Australian economy is really weak and it requires support from here on in. So the RBA surprised us at its last decision by keeping interest rates on hold, even though there's the argument now, given the recent data, that it should have actually cut interest rates. But nevertheless, it despite sort of perhaps messing up its language a little bit in terms of its guidance at its last decision, it's very unlikely we'll get some sort of surprise here because it was more or less waiting for that official CPI figure that we'd already got. It's behaved. So the RBA has everything it needs to see basically to cut interest rates. It has to be said, because so much is already priced in, a drop in the Australian dollar and a big rally from the ASX 200 is fairly unlikely. If anything, the risk is asymmetric. The unlikely event of a hold would see a Australian dollar that would, obviously rally quite a lot. The ASX 200 would likely drop. The flip side of that too, if the RBA does cut 50 basis points, which, is a possibility, but quite unlikely as I see it, then obviously we'll see a very significant move in the Australian dollar and the ASX 200. But that's very much a sort of a tail risk scenario. And it also has to be said too that, you're probably going to see the Australian dollar, driven a little bit more by some of those global factors, which it typically trades in line with anyway, which is, US dollar weakness this year, as well as the outlook for the Chinese economy, which has to be said hasn't recovered in a very strong way this year, but certainly has shown greater signs of life and a very moderate and slow increase in economic activity. You can kind of see that actually expressed on the Australian dollar chart, which if you strip out just that noise around Liberation Day, which is more of an example of a market experiencing dislocation and therefore wasn't behaving efficiently, you can actually see that we're in an uptrend for the Australian dollar this year. The big level is obviously 66 cents. That's where we've seen a big sell-off in the past. There is that kind of cluster of support, you could argue, at around 64. So there's your ranges. Again, a surprise hold would see the Aussie dollar probably push higher from there a little bit. A 50 basis point cut, as unlikely as it happens to be, could really see that Swift move back into the 64 handle. So there we go. That's another Market Mondays for another week. Obviously, greatly appreciate your attendance once more. Please share this. We have it online on YouTube after the fact. So share it around if you could. Invite your friends to this webinar. We'd love to pick up the attendance as much as we possibly can, and we'd love to see you once again as well next week for the latest installment. So trade well. Trade safely and manage your risk carefully as always, and look forward to presenting again to you next week.